This is Nightly Business Report with Bill Griffith and Sue Herrera.
Late fade. Stocks tried for their first three-day win streak this month, but they couldn't hang on. Is the bounce over? Market or economy? Stocks seem to be seeing something different about the economy than what many of the fundamentals say. So which is right? And saved by the bell, Sears gets a lifeline at the deadline today. So what's next for the iconic retailer? All that and more tonight on Nightly Business Report for this Friday, December the 28th. And we do bid you a good evening, everybody, and welcome for this Friday. Sue has the night off. Well, it looked for a time today like stocks were going to make it 3 straight days of gains for the first time this month, but it didn't happen. Remember yesterday, a final hour push sent stocks higher. Today, it was exactly the opposite that happened. But the reality was that stocks were all over the place. The Dow was up more than 240 points at its high water mark and then ended lower while hitting break even several times throughout the session. Here's what we looked like at the end. The Dow was down just 76 points, still above 23,000. The Nasdaq held on for a 5-point gain, and the S&P was down just 3. And after all the volatility this week, this turned out to be the first up week for the indexes this month. With the Dow and the S&P gaining nearly 3%, the Nasdaq climbed by 4. But Bob Pisani tells us now the market has some key issues coming up.
After the dismal month that was December, most investors are eager to put the month behind them and move on to January and the new year. So what are the key issues the markets are grappling with for the first few weeks of 2019? Well, here's what I think are the 5 biggest ones. First, it's money flows. Investors traditionally put money to work in the first weeks of January. But will they do that after the worst December since 1931? Second, what will corporate earnings look like? Investors are still expecting earnings growth of about 8% in 2019, but after cautious comments from FedEx and Micron, the market's acting like there will be zero earnings growth in 2019. So will the analysts take down their numbers, or will the stock market just keep going up? Third, is there any progress on China trade and tariff talks? Will we see real face-to-face meetings with even low-level negotiators in January? China's indicated that we will. Fourth, we'll get the minutes from the latest Fed meeting on January 9th. Do Federal Reserve officials send even more passive signals, particularly when it comes to unwinding their balance sheet? Finally, there's Trump and political risk. Will a calmer White House emerge, or will the relative chaos continue? The resignation of Defense Secretary James Mattis, in particular, has removed what many viewed as a stabilizing force over there, and all the markets want is stability from everybody, from the Fed, from China, and from the White House. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, this week's gains pulled the averages further away from bear market territory. And while that term, bear market, is a technical term, many investors do put a lot of weight on it, especially in terms of it being a recession forecaster. So we asked Steve Leisman to look at the essential ingredients of a bear market.
How good a job does a bear market or a 20% decline in stocks do in predicting recession? The answer? It's terrible at predicting, but not bad at telling us if the economy is in recession right now. First, a technical note. By the barest of margins, it's not a bear market. The S&P 500 only closed down 19.78% from the September 20th high, not the full 20% that officially denotes a bear market. But it's close enough to ask the question, just how smart is the average bear? Here's data CNBC analyzed from Bespoke Investments. In the post-war era, there have been 13 declines of 20% from the prior high. The good news is 5 times it did not result in a recession in the next 24 months. The bad news, 8 times the economy was already in or on the verge of recession. Couple examples. In 1987, a big stock decline, but no recession. In 2001, a recession was 3 weeks away from that 20% decline. No recession in 2002. And in 2008 and 2009, when the stock market fell 20%, the economy was already in a recession. A bit more bad news here. From the 20% decline, stocks fall an additional 8% on average during a bear market. But some good news. The average increase 1 year later, 14%. The meanest of all the bears we could find, from 2007 to 2008, there was a 52% decline. The nicest of all bears, 1956 to 1957, when stocks fell just 21%. Right now, we're about 15% below the September 20th high, so moving away from bear market territory. That's good news. If we go back there, markets will have to worry not if a recession is being predicted by stocks, but if it's telling us we're already in one. For Nightly Business Report, I'm Steve Leisman.
And we did have some mixed economic data out today, as a matter of fact, with numbers showing that business conditions in the Chicago area remain strong, but pending home sales around the country fell in November. And one of the head-scratching themes recently, of course, has been this divergence or seeming divergence between how the stock market sees the economy and what these economic reports are saying right now. But the former head of the NASDAQ thinks the answer is simple.
When I look at the market today where I see a disconnect, I see that next year corporate profits are estimated to grow 5, 7, 8%. We think general GDP will grow 2 to 3%. So that's not a recessionary environment. And I think the market has been somewhat disconnected from those fundamentals. And if I was an investor, I would always focus on what the fundamentals are telling me and not pay so much attention to volatility in a market in a given day.
Well, let's talk about it right now. We have with us an eminent money manager with us tonight and an eminent economist. Chris Ailman is the Chief Investment Officer with the California State Teachers Retirement System, or CalSTRS, and Joe Brusuelas is the Chief Economist at RSM. Good to see you both. Thanks for joining us tonight. Chris, let's start with you. It's going to turn out to be the worst December for the U.S. stock market since 1931. For you, what is this stock market telling us about the economy, if anything?
Well, as Steve Leisman said, it's not good at predicting recessions, but I think it's pretending that the first half of 19 will be a slower growth economy than we had in the latter half of 2018. And I think the market's actually a little bit overdone in terms of being very nervous about what the Federal Reserve said a couple of weeks ago.
All right. Joe, do you see slower growth in 2019 relative to what we've seen so far this year?
I do. I'm expecting 2.2% growth next year as we move back to the long-term trend of 1.8%. That financial volatility you've seen over the past 3 months should be considered a proxy for slower cash flows linked to trade tensions around the world out of the White House. That's not going away, and in fact, we think it's likely to be intensified by mid-year. So the market, I think, is a little bit ahead of the economy, and you should expect that economy to meet that market by the middle of 2019.
So you think the economy will slow down to confirm what the stock market seems to be saying? I don't want to put words in your mouth, but is that what you're saying right now?
No, that's about right.
Yeah.
The long-term trend growth rate of the United States is 1.8%. Some of what you're seeing is clearly concern that the market can't sustain a 3% pace of growth, which most economists completely disagree with. That's more of a political sentiment than rational economics analysis. So I see a fundamentally strong economy slowing back to trend, and then we can worry about recession risks in 2020 should there be a policy out of the White House or the Federal Reserve, or just a general macroeconomic slowdown linked to trade tensions.
Chris, I know you manage a huge portfolio. You try and keep high altitude and not worry too much about short-term headwinds, but we have had a lot of them in the last few months here with the trade tiff between the U.S. and China, a slowdown in technology demand. Oil prices have been going lower. Are those things that concern you and get you to think about how you manage the money in the CalSTRS portfolio?
Well, absolutely, Bill. It gets me to grab the Rolaids every day. It's the risks that abound in the marketplace, but we've rallied and seen markets climb with those risks. I think volatility is here to stay. Not that we saw here in the last part of December, but the volatility we saw in November and October. And you're right, you've got to keep your eye on the long term and manage your asset allocation so that you're not overweight stocks. We're using these drops to actually come back in and add to our portfolio because we think we want to stay within that range and stay exposed to the U.S. economy.
At this point,
the key word was growth.
Yes, indeed. At this point, the Federal Reserve is expected to raise rates twice in 2019. For you, Chris, is that a good thing or a bad thing when it comes to equities?
If the Federal Reserve is raising rates, it's because the economy is strong. But I think right now what I'd rather see out of the Fed is for them to be more data dependent. Wait and see, not just predict what they're going to do well out into the future.
Joe, how many rate increases do you see next year?
Well, we see the Fed on pause till at least June of 2019. And if the economic growth and hiring continues to be roughly above where it's above trend. We expect 2 rate hikes, one in June, and possibly one in September or one in December for 50 basis points total, and that's it.
All right. Gentlemen, thank you both. Always enjoy talking with both of you. Chris Ailman with CalSTRS, Joe Brusuelis with RSM. Happy New Year. Now, yesterday we told you about the tax loss selling strategies that might have contributed to some of the year-end selling. Tax loss selling occurs when you sell losing positions in order to offset any capital gains that you may have earned from other investments during the year. And Monday is the last day you can do that. Leslie Picker has a few tips.
There's one key rule to tax loss selling, and that is if you're disposing of one security for tax purposes, you cannot buy a substantially identical security within 30 days before or after the transaction. This is called the wash sale rule. But what happens if an investor still likes their losing positions for the long term? Well, Bob Willens, a tax advisor to institutional investors, shared some legal tricks to maintain exposure to certain securities. One way to do this, he says, is through investment holding companies. For example, if an investor wants to sell Alibaba, which has plummeted about 20% year to date, he or she can buy something called Altaba, which is the result of a spinoff that essentially is just a holding company for Alibaba shares. Another one of Willens' ideas, stock-based mergers. Investors have been locking in losses in Disney shares and buying that of 21st Century Fox, he says. The two have signed a deal to merge, so their shares will soon be combined anyway. Lastly, any ETF. An investor will violate the wash sale rule if he or she buys a different ETF that tracks the same index, but what he or she can do is buy some of the underlying holdings within that index to get market exposure. But Willens says one should not buy all of them, that going above, say, 450 stocks in the S&P 500 could cause an investor to lose the deduction. For Nightly Business Report, I'm Leslie Picker.
This was billed as a do-or-die day for Sears today. Anyone interested in buying the struggling retailer out of bankruptcy had to have submitted a bid by 4 p.m. Eastern Time. If no bids came in, Sears faced the possibility of liquidation. Lauren Hirsch is with us. She's consumer and retail reporter for CNBC.com. They got a bid, didn't they?
They got a bid. I can tell you my sources have told me that they at the very last minute submitted a bid. So it is possible that Sears can avoid liquidation, but there's still uncertainty to come.
Do we know who the bidder was?
ESL. We know that ESL submitted a bid.
And that is the hedge fund run by Edward Lampert, who has been the chairman of this company and was CEO for a time as well of Sears.
Exactly, and a very big investor in Sears. As through ESL, he invested in Sears throughout its troubles as a public company, and it seems he will continue to invest in Sears even in bankruptcy.
Now, this is a lifeline, but they're not out of the woods yet, are they?
Absolutely not. It's a great question. One of the really big issues that Lampert faces is the unsecured creditors have said they don't want a credit bid. What a credit bid is basically Lampert says he has some debt owed to him by Sears, and he's willing to forgive that debt. And in exchange for that, he's going to kind of count that towards his bid.
Right.
I haven't seen the terms of his current bid yet, but if he tries to do that, the unsecured creditors have said they will not allow it. They don't like how Eddie Lampert ran Sears. They have questions about some of the transactions that he did while CEO, and they have said there could be potential cause for litigation.
And does this bid have to be approved by the bankruptcy court?
Yes, it has to be approved by the bankruptcy court, and Sears advisors need to decide, hey, Lampert's bid to keep Sears alive is worth more than liquidators' efforts to liquidate it, and that's not black and white.
And we don't know yet when they're coming out of bankruptcy, do we?
No. We don't know if they're coming out of bankruptcy.
Exactly. I mean, it's still, they got the lifeline.
Yes.
But they still have to keep treading water at some point.
Exactly.
Lauren Hirsch from CNBC.com. Thanks for joining us
Thank
tonight.
you.
Coming up, this week's Market Monitor thinks that the economy is not as bad as some fear. He has 3 names he thinks you should have in 2019. Electric car maker Tesla named 2 new board members today. One of them is Oracle co-founder Larry Ellison. The other is Walgreens global head of human resources Kathleen Wilson Thompson. The appointments satisfy a September deal with regulators, stemming with CEO Elon Musk's controversial tweet about taking Tesla private. Tesla shares rose more than 5.5% today to $333.87. And from Tesla to President Trump's tariffs and trade war to rising interest rates. All of them factors that affected the automobile industry this year. And this year that is projected to be a good one for the U.S. automakers overall. But what about next year? Joining us right now, Michelle Krebs is executive analyst with Auto Trader. Good to see you, Michelle. Thanks for joining us again tonight.
Thanks for having me.
How would you characterize 2018, first of all? Good year, bad year, middling?
It was a surprisingly good year. It surpassed forecasts, including ours. It looks like it may come in just a little bit ahead of last year, in fact.
But Ford is changing its strategy. It's going to eliminate a lot of vehicles and focus on trucks. General Motors is closing factories. What about for 2019?
Well, for 2019, we think the market will be down a bit. Still healthy. We're anticipating 16.8 million sales versus 17.2 this year. So still a really good year, but it's going to get tougher. Interest rates rising, the threat of tariffs. There are a lot of headwinds that are looming.
And the loss of high-profile personalities, the death of Sergio Marchionne at Fiat Chrysler, Carlos Ghosn at Nissan, Ferrari. How has that impacted that, if any, at all?
Well, they were surprising news in 2018, the death of Sergio Marchionne, the imprisonment of Carlos Ghosn in Japan. But I don't think they've affected the companies per se. There was a very smooth transition at Fiat Chrysler. Nissan, we'll see. They're still working through all of that. But those will be things we watch in 2019 for sure.
Do we see the rise of electric cars more this next year, do you think?
Well, sir, we will be watching Tesla. They are the ones driving electric vehicle sales. They had a good year. They actually had a profitable quarter. That was one of the things we underestimated about last year. But can they continue when there are more EVs coming to compete, and can they continue to earn a profit? Those will be things we're watching.
Who's the winner next year, do you think, auto-wise?
I think trucks and sport utilities will still continue to be the cat's meow.
They are calling the shots, aren't they? That's for sure.
They are.
Michelle Krebs with Auto Trader. Again, thanks for joining us. Happy New Year.
Thank you.
Wells Fargo settles with state AGs, and that's where we begin tonight's market focus. The bank is going to pay $575 million to settle claims made by states that the bank created phony accounts and other consumer abuses. Remember, 2 years ago, Wells Fargo agreed to pay $190 million to settle federal claims over those same accounts. Shares of Wells Fargo rose a quarter today to $45.78. Dell returned to the public markets today after nearly 6 years as a private company. The move follows the buyout of Dell's tracking shares in software firm VMware. JP Morgan set a $60 price target on the stock. Shares closed up nearly 2% today on its first day of trade to $45.43. First Republic is going to join the S&P 500 index prior to the open of trade on January 2nd. The bank will replace Scana Corp, which is in the process of being acquired by Dominion Energy. First Republic rose 5%. A lot of institutional interest now. It closed at $87.94. Procter & Gamble and IBM have said that former American Express CEO Ken Chenault is going to retire from their boards. Both exits are effective February 13th. Shares of P&G and IBM closed down less than 1% in today's trade. And new government data show that Spirit Airlines was on time more often than any other U.S. air carrier in October. Spirit's flights were on time about 81% of the time. That is in contrast to its general reputation of drawing more complaints from consumers than any other airline. Spirit rose 0.75% today to 57.52. The FCC is launching an investigation now into that nationwide outage at telecom company CenturyLink that knocked out 911 voice calls in parts of the country. It started yesterday and affected many other services as well, including some Verizon mobile data, even ATM withdrawals. FCC Chairman Ajit Pai called the outage at CenturyLink completely unacceptable. Shares of the company, though, were up 2% today, up 2 cents to $15.27. Time now for our weekly market monitor, who has stock picks that he says you will want to own if you believe the economy will continue to grow in 2019. Steve Cheverone is the portfolio manager at Federated, joining us tonight. Steve, good to see you again. Welcome back.
Happy New Year.
And you start with AbbVie, and this is a dividend play for you. Is that the reason you like this one?
Yeah, the general theme is we want to buy some of the things that have been beaten up between September 20th and Christmas Eve. Dividend stocks are kind of the opposite of that. They had gotten beaten up until September 20th. As the market was rallying and interest rates were rising, there was an expectation that the Fed was going to raise rates 4 times a year between then and forever. Well, the Fed's already dropped next year's kind of rate hike expectation down from 3 to 2. We doubt that they'll be able to hike at all in 2019. And the dividend players are getting a bit of a bid, particularly because they're a little bit more defensive. So AbbVie is a great example of this. They've got a yield that's almost 5%.
Yeah.
And they just signed this settlement with Pfizer, which ensures their key drug Humira will continue to generate cash flow, should support the dividend, and allow them to invest in new drugs.
Your second pick is Amazon, and this is a good example of the market versus the economy. Amazon had its record Christmas this year, but yet the stock is down 34% since its high in September. You like it because of the decline, or what's going on here?
Yeah, we think that there's a number of names that have been priced for recession without a recession coming. And so what you have here is the consumer is quite strong. We see that. Not just did Amazon have their best orders, but we're having the best holiday shopping season in 6 years. AWS continues to do well, which is their cloud business. Some of their other initiatives around Prime are doing well, as well as private label and Alexa. And so you have a name that we think is overly beat up. It's a cyclical name, but we think it can rebound from these levels, and you've already seen that over the last couple of days.
And finally, you've got a small semiconductor company, Diodes.
Yeah.
Now, we've heard from other money managers who like the semiconductors, again, because they feel like they've been beaten down too much, just like you feel about Amazon. Why don't you pick one of the bigger guys? Why choose this small cap in the semiconductor area?
Yeah, Diodes checks a lot of boxes. So number one, small caps have gotten beaten up when rates were rising because 50% of their funding is variable. It's variable interest rate versus large caps where it's only around 10. So as rates fall, and we've gone from 325 on the 10-year down to below 275, that should provide some relief. So that's one. Number two, small caps have underperformed by about 7% this year relative to the S&P. We think there's some catch-up.
All right.
This is a name with high foreign sales exposure, so the dollar weakening a little bit helps. And it's also related to trade with China, which is where it sells a lot of its goods. So any progress there helps as well. So it's kind of all of these themes put together in one stock.
Steve Cheverone with Federated again. Thanks for joining us. Appreciate it. Have a good New Year.
You too.
Coming up, the unused gift that can be a burden to retailers. Here's a look at what to watch next week. Busy week. It's a holiday shortened week. Markets are closed on Tuesday, but on Thursday we get a look at sales numbers from the big automakers. Then it's all about the labor market. Thursday we get the weekly unemployment claims, and Friday it's the big December jobs report. And that's what we're watching for next week. Could be some more volatility, as a matter of fact. The holiday shopping rush has passed, but many consumers are now armed with those gift cards that allow them to cash in on the post-Christmas deals. But not everyone uses their cards right away or at all. And as Frank Holland tells us, that has a bottom line impact on retailers.
Gift cards, the plastic and e-versions, were the most popular gifts of the 2018 holiday season.
I actually enjoy getting them more because then you can kind of pick out exactly what you want. I find it's easier to give them, and they're just really fun to receive as well.
Millions of Americans see the gift card as a convenient alternative to picking presents. According to Wallet Hub, gift cards from Amazon, Visa, Walmart, American Express, and iTunes were the predicted top picks this season.
We like the Amazon because we do a lot of our shopping online.
I received a gift card for iTunes. I don't really use iPhone anymore, but it's good to still have music anyway.
I have received a Visa gift card and also a Starbucks gift card.
But even when people get one from their favorite store or brand, they don't always use them right away. It's estimated at least $1 billion of gift cards go unused every holiday season. According to the National Retail Federation, 42% of people say they wait until a good sale to use their card. 20% say they use them quickly. Another 20% say they save them for a rainy day.
I usually wait a long time. Sometimes I forget about it.
I try to do them within a month or two because I find that when I don't, I end up losing them and misplacing them. So I try to use them as soon as possible.
I do have a collection of gift cards, so that sometimes is the problem. So now if I get a gift card, I'll try to use it as soon as possible so I don't forget it or lose it.
And people not using their gift cards is actually a bigger issue for your favorite stores than you might think. Retailers can't count the money you spend as revenue until you actually buy something. For Nightly Business Report, Frank Holland.
So where does that unused money go, you might wonder? We wondered. There isn't a universal answer, it turns out. Different companies handle it in different ways. Many use a specified time, usually between 2 and 5 years, before they convert the unused gift card funds to revenue. And then if that's not enough, some states have unclaimed property laws that send some of the money to states' coffers. Aren't you glad you asked? Before we go, a final look at the day on Wall Street, capping off a very volatile week, down 76 points on the industrial average, still above 23,000 though. The Nasdaq held on for a 5-point gain, and the S&P 500 was off just 3 points. But after all the volatility we saw this week, it turned out to be the first up week for the indexes this month. The S&P and the Dow gained nearly 3%. The Nasdaq climbed by 4%. What a week. That is Nightly Business Report for tonight. I'm Bill Griffith. Thank you so much for watching, everybody. Have a great weekend. See you on Monday.